Hello everyone, and welcome once again to another edition of the Money Pros. I'm Oliver Tutt, Certified Financial Planner Practitioner. I'm going to be your host for the next half hour as we talk about all the issues related to your money, how to make it, how to keep it, and of course, how to help it grow. On today's show, we've got a lot to talk about. First up, we're going to be talking about elder abuse. This is more and more common topic when it comes to finances, and of course, we're going to be talking specifically about financial elder abuse, what the scams are and what you can do to try to avoid them if in fact you are elderly or perhaps you have a loved one who may potentially fall victim to one of these crimes. So we're going to be talking about that. In our second segment, I have my partner with me from Randall Financial Group, none other than Matt Sweet, Certified Financial Planner, IRS enrolled agent, and we're going to be talking about what I would call the age-old question of money, which is the investment question. Should I invest or not? This goes back as far as man has assets, whether it was grain or fur pelts or whatever. That's not what we're going to be talking about, but it's kind of a classic question. Should you invest or not, and how do you know? So we're going to be talking about that in the second segment. In our third segment, I'm going to be talking about something that came up, it sparked my interest. I saw a Facebook post, and I'll explain more in the third segment. But Brown University announced their performance for their endowment fund for the fiscal year ending June 30th of this year. And it got me wondering, how does their performance compare with another large endowment fund here in Rhode Island? And that is, in fact, the Rhode Island Pension, which is not, of course, a classic endowment fund, but it is a major institutional investment. And so we're going to want to take a look at, compare the investment performance of the two over the same time period and see how they perform. And then finally, in the last segment, we have a question from someone with respect to withdrawing money out of a UTMA account, Universal Trust for Minors account. So we're going to tackle all of that. But first up is the question of financial abuse when it comes to seniors. Senior citizens are particularly vulnerable to scams when it comes to their finances for a variety of different reasons. Perhaps they're less mentally aware. That's certainly not always the case. I know from many of my senior clients are perhaps some of the sharpest people I deal with, but some of them, that's not always the case. They tend to deal more person to person. They're vulnerable to personalities and things like that. And it got me thinking about this because there's a survey that just came out from the North American Securities Administrators Association. Now, this is the association of state organizations that are responsible for securities regulations. So this is not a private industry thing. This is actually public regulators. And they recently released their inaugural report, August of 2017, on senior financial exploitation. And some of the numbers were pretty surprising. 97% of regulators indicated that elder fraud is either staying level or is actually increasing. So this is not a problem that is becoming less and less common. They also noted, and this has been my experience as well, that most cases go undetected until asset recovery is too late. In other words, they've been scammed out of their money, and by the time anyone figures it out, it's really too late to do anything about it. The parties have fled, the money is gone, and it's just simply no longer available. And they came up with a list of suggestions, but the top suggestion for what needs to be improved is we need to do a better job of investor education and outreach. And nothing speaks to the goals of the Money Pros more than investor education and outreach. So I thought this was an important topic to talk about. So let's talk about three things where I think we can help elders to avoid being financially scammed or abused. And put up a slide. We're going to walk through each of these one at a time. The first one is you have to know the scams. If you're not aware of what can happen, then it's very easy for you to be a victim of them or for somebody that you love to be a victim of them. So know what the warning signs are, know what the scams are. According to National Association of the Elderly, the most common scams are, number one, people pretending to be from Medicare. Most elderly are on Medicare, and so it's pretty easy to call them and talk to them about Medicare scams. The other scams are online counterfeit prescriptions as seniors look to find better deals on prescription drugs, funeral scams, and phone scams. So those are some of the most common scams. Next, you have to watch the paperwork. If you have somebody you know who's elderly, you got to take a look at the bills that are coming in. Watch the mail that's coming in. Watch the bank statements. Watch the credit card statements to be very careful that you're not being taken advantage of, or more importantly, somebody that you love isn't being taken advantage of. So pay attention to the mail, pay attention to the statements. And finally, it's very valuable to employ a team, not only a team of family members that are paying attention to the finances, but also potentially attorneys, accountants, and financial advisors, all part of a team working together. If one of those individuals decides to take advantage of somebody that's elderly, it's going to be very hard for them to get away with it if there are other members of a team paying attention. But when there's only one person involved, whether it's a family member or maybe just one financial advisor or accountant, the potential for abuse goes up dramatically. So those are some of the suggestions to avoid it. Be aware what the scams are, and then employ a team to help you avoid some of those things with some checks and balances. All right, that's it for that segment. Up next, we're going to be talking to Matt Sweet, Certified Financial Planner with Randall Financial Group. We're going to be talking about the investment question, should you or shouldn't you? Stay tuned, there's more to come. Welcome back to the Money Pros. I'm joined now by Matt Sweet with Randall Financial Group, my partner in, I was going to say crime, but that's probably not the best reference. Have I said it before? All right, we'll try something else next time then. So, Matt, we're going to be talking about something that, this may not seem like the kind of thing that comes up all the time, but in my experience, it comes up frequently. We have clients that ask all the time. They come into money from a variety of sources, and it can be a little bit of money or it can be a substantial amount of money, and of course that's all relative. But they're always asking, or they're often asking the same question, which is, should I invest it? Yeah. So we were talking about the fact that a lot of things start going on in our heads when somebody asks what seems like a fairly simple question. But what do you think about when somebody asks you, Matt, I've got this money that I just came into, should I invest it?
Right. I feel like I give people a blank stare because, without knowing a lot of other information, you can't really make that determination. So, what do I immediately think of? I think of the goals that what the goal the person has for the money. That's primarily it. And then, and related to that is, like, what is their risk tolerance and what's the time horizon? So the time horizon is very closely related to the goal that they would have for it.
So it really triggers a whole slew of other questions. Right. And I feel like, and this happens a lot as a financial planner, somebody asks you a question and you answer it with 6 other questions, which I think I try to avoid as much as possible, but it's inevitable to some extent. But let's talk about the goals, because you're talking about before you're able to answer that question for the client, or the client is able to answer for themselves, they need to know what the goals for the money. Why is that so important?
Well, I'll give you an example. This is a friend had $10,000 that he wanted to invest. He wanted to buy stocks with it. And I asked him, well, what's the money for? And he said, oh, it's for my wedding next year. So immediately that triggers in my mind, well, it's not a good idea to put your wedding money into stocks because of the potential for loss over a short term. So, the upside is maybe he could have gained 10 or 20% of the money, but the downside is that he could have been out a wedding in a year.
So he could have lost 10 or 20% of the money. So this gets to a fundamental, we can start to talk about some investment lingo, and the better people can get at some of the vocabulary, sometimes it helps them to understand some of the investment principles we try to coach people with. But you make an excellent point about, in that short term, needing the money for a purpose like a wedding or something like that. And we talk about 2 terms, and they are liquidity and marketability.
Right.
And I find it's interesting because people use the terms interchangeably, synonymously, but they really mean 2 different things. So let's talk about marketability first. What is marketability?
Right. Marketability has to do with, like, how quickly you can sell something without necessarily seeing a loss. For instance, you could have something that's very valuable, like a Van Gogh painting, but if you needed to sell it in a week, you would probably sell it for significantly less than its true value. Right? So that has to do with its marketability. How quickly can you sell it without losing its value, essentially?
So I'm going to disagree with you here, because I think that that's the definition of liquidity. Mm-hmm. In my experience, people use the term liquidity as being able to convert something into cash. But when you're talking about something that is like a stock, we usually talk about a stock as something that's very marketable,
Right.
but is not particularly liquid, because liquidity implies being able to convert it into cash. Marketable just means easily
Sell
sellable.
it.
Do you disagree with that?
Well, I do, because stocks are liquid, but they're liquid because the market makes them liquid. There's a large market in stocks out there. So I think there's a lot of relatedness to these two concepts.
But I think this gets to the core issue at hand is you and the client, or me and the client, whoever you're advising, you have to have a pretty clear understanding of exactly what the intent is for the money, and this gets back to the goals. I mean, you're talking about your client that is getting married. They put the money into stocks. They're not going to have trouble selling the stocks when the wedding comes, right? The question is, what are the stocks going to be worth?
Right, precisely.
Okay. So give me some examples of assets that you would consider marketable.
Well, anything is marketable as far as like how, can you sell it? Marketable assets are stocks and bonds,
Well, then let's talk about on a spectrum, things that are more marketable versus less marketable in the classic sense.
Right. So you would say things that are very easily converted into cash, like investments like stocks and bonds, particularly bank investments, things like that.
So,
whereas real estate would take a lot longer to sell.
Okay, so perfect example, right? So somebody calls you up and says, I've got this mutual fund in my account. It's worth $10,000. I need you to sell it, and I need the $10,000. It takes overnight, 72 hours maybe, between the selling and the getting the cash into the client's bank account. Client says, I need to sell my personal residence because I want to buy another personal residence.
Right, it could take 6 months or more to sell it.
So that's a classic example of the marketable. Now let's talk about liquid. What would you say are things that are liquid?
Well, cash assets, like bank accounts. We don't think of them as so much investments, but they are. And they are convertible into cash for making other purchases. All right?
So liquid is really marketable with the added advantage of being less likelihood that you're going to take a loss on the asset.
That's right.
Right? So checking account, you've got $100,000 in your checking account. We've seen this. Pretty liquid, right?
Yes. Right.
In addition to being marketable. I think we would probably agree with that. What are some examples of where risk tolerance would come in terms of making the decision about should I invest or not?
Right. So this often comes up where people have a desire to invest and gain from their investments. However, if you invest in something particularly risky, then you also have the problem that in the short term you could end up losing money. So if you had a client and you said to them, well, what would happen if the investment lost 20% in the next year? And they said, well, I would just sell it and put the money in my mattress or something like this. Well, that would be an example of the risk tolerance being too low for that type of an investment. So it wouldn't be wise for that person to invest in something, even if it was otherwise a good investment, because their risk tolerance basically wouldn't allow them to do it.
So we were talking about example, we'll go back to the wedding fellow as an example, right, where he wants to put the money into the stock market. He's going to need the money in a year. He shouldn't invest because it's an issue of time horizon, essentially. He needs the money too soon. He's getting marketable and liquid confused, essentially. But you could have a situation where somebody says, I don't need the money for 10 years, and that would meet the sort of time horizon checkbox. But what you're saying is if they indicate that if the investment declines, they're going to want to get out of it, you'd advise them against investing the money.
Right.
Are there any other considerations in your mind to whether or not a client should invest the money besides the risk tolerance and the time horizon?
Well, the goal is going to be dependent on how much gain you need to get out of your investment. All right. So long term, you think about retirement, you need your assets to grow significantly in order to keep up with inflation and just to grow to provide income. So in that case, you'd want to be invested in things that will grow more, but in order to get more growth, you have to be willing to take more risk. So there's this trade-off.
Intertwined.
They are. There's this trade-off between taking risk and getting a return for it. So some assets, like, you know, say small cap stocks, higher rate of return generally, but more risks of loss.
And then how can we manage the risks in the portfolio? Right. If, you know, time horizon's good, they don't need the money for a while, they've expressed a risk tolerance that's sufficient to invest, but perhaps not all investments are suitable.
Right. Well, this is where we start talking about assets in a portfolio, like you just mentioned. And when assets are in a portfolio, we think about how these assets are correlated to one another. So when you take assets and put them together that have different correlations, all right, and then what that means is that they act differently. You know, when one goes up, the other one doesn't necessarily go up. That actually reduces the risk of the portfolio. And that's called modern portfolio theory, and we could talk a lot more about that.
That would be like a whole nother, I think, segment that we would have to go through. So somebody asks a very simple question: should I invest or not? Answer gets pretty complicated. It does. So you really have to be able to wade through this with the client. I think that this is one of the things we do, unless the investor can wade through it on their own, which many people can. It's helpful to talk to somebody about it. Yep. All right, Matt, very helpful as always. All right, up next we're going to be taking a look at another portfolio, Brown University Endowment, and how that performance compares to Rhode Island's pension plan. Stay with us, there's more to come here on the Money Pros. Welcome back to the Money Pros. So now I want to talk about a topic that sort of came to my attention via Facebook, and I have to say that social media is a great source for topics for this show. Sometimes raising some very good questions, sometimes raising some really ridiculous questions, but this, I think, is part of the former and not the latter. So one of the things that came out on Facebook was just somebody shared the news that Brown University released the investment performance for their endowment fund. So what's an endowment fund? So Brown University has a massive investment fund, primarily money that is given to them by donors, large and small, that they accumulate into a large investment fund, and then they can make distributions from the fund for anything from scholarships to building a new building to any number of other programs. And basically, it's money that can be used to supplement their operations. And there's a very specific way in how it has to be distributed. And Brown University has an investment committee and full-time employees that manage the fund. But they released information on the performance for the fund, and their fiscal year ends June 30th of 2017. So they're basically on mid-year fiscal years. And the endowment fund is not a small amount of money. It's $3.8 billion with a B dollars. So it is a lot of money, and one would expect that it is managed very professionally. So it would be an example of a benchmark on how one should manage money. But then I saw another Facebook post from a well-known businessman here in Rhode Island who is also rumored to be a candidate, a potential candidate for governor during the next election. I don't know that that's true, but it's a rumor that I've heard. And his post referenced Brown University's announcement on their endowment performance. He congratulated Brown on doing a great job on how they manage their money. And then he went on to draw a comparison between how Brown University had done with their endowment and speculating as to whether Rhode Island's pension plan had been managed as well, and went on to make some insinuations about how the former treasurer, now governor, and current treasurer are using hedge funds and private equity, and how expensive it is, and how it probably has damaged the performance. And it got me wondering, I wonder how the performance actually compares. So we decided to take a look. So one of the good things is the state provides very detailed information on exactly how the pension fund is doing on a variety of different time periods. You can also look in detail at what investments are held, what the expenses are. They provide a very high level of disclosure, as they should, because it's a public pension fund. Brown University, however, does not provide the same information. That is a private endowment. They don't have to tell you what they're invested in, nor do they give you terribly a lot of information. But here's what we know. Let's throw up a chart and I'll tell you what the numbers are. Now, This first red bar is an indication going back a year from June 30th, 2017 to 2016. The red bar is the S&P 500, and the S&P 500 in that time period is up 17.9, nearly 18%. Next, that green bar is the Brown University endowment, all 3.8, I think I have 3.5, but it's actually $3.8 billion of it there. The Brown University endowment announced performance of 13.4% for that same fiscal period. And finally, the Rhode Island Pension Fund, which is actually significantly bigger at $8 billion, their performance was 11.8%. So difficult to tell whether one really did better than another, because there are a whole slew of issues, including the benchmark objectives, the fact that the cash flows are substantially different out of the Rhode Island Pension Fund than the Brown University endowment. But I at least wanted to answer the question, how do the two compare? Perhaps on a future episode of the Money Pros, we can talk in more detail about how to compare them further. But on first blush, really not that big of a difference. All right, up next, we're going to answer a question on taking money out of a Universal Trust Minors account. So stay with us. There's more to come here on the Money Pros. Welcome back to the Money Pros. Got a great question. This wasn't a viewer question. This was actually a client question. I thought I would share it with the audience because this has come up a couple of times and have always been a little surprised when the question is asked. But here it is. Someone asked, I need some cash for a down payment on something. I'll leave the something out, but it was a pretty substantial amount of money, and don't have enough in my bank account. Can I use the money in my son's Universal Trust to Minors account temporarily and then put it back later? Now, I would point out that this parent had no intention of taking money from a child or anything like that, and made it very clear that they planned on putting it back later. But oftentimes people get caught in a situation where they need to lay their hands on a bunch of cash. In this case, it was for an opportunity, and they saw the cash in the Universal Trust to Minors account and said, hey, I can take money out of that account anytime I want. Well, there's a difference between can you and should you. So the official answer is no, you can't do that. The reality is that there is a law preventing you from doing that, and you act as the trustee on that account, and that account can only be used for the benefit of the minor. And if the minor should ever find out that you used the money for some other purpose, they could actually sue you. Now, you can get into questions if you're ever going to get caught, particularly if you put the money back, but that's not really what we're talking about here. So, unless the money is for the purpose of benefiting the minor, you cannot take it out to purchase or to put a down payment on something for your own benefit. So hopefully that clarifies that question, as we try to on so many questions here on the Money Pros. Thanks for watching, folks. As always, have a great weekend. We'll see you next week. Take care.